Hello and welcome to this video on financial analysis. In this video I want to make a deep dive into the cash flow statements. For this video I planned the following. First of all, I would like to share some preliminary thoughts, especially about the objectives of the cash flow statement. Then I would like to make a three-step creation of a cash flow calculation with you. First, we have to create a movement balance sheet. Second, we have to reorder it. And for the last step, we have to draw subtotals and make some necessary corrections. I end this video with a real case with real numbers. This is a balance sheet as we know it. The balance sheet shows the financial status as of typically the 31st of December of any year, so for the end of the financial year. And usually we see the preliminary or previous year in the balance sheet too for comparative reasons. So we see the financial year and the preliminary year. This is a very simplified calculation because for didactical reason I just look at the big items of this financial status or balance sheet. We look at the non-current assets and the current assets and, attention, at the cash and cash equivalents. I have excluded the cash and cash equivalents from the current assets because usually cash and cash equivalents are a part of the current assets, but not here. I have excluded them and made them an individual item. Of course, the assets sum up to total assets, so here we have the sum, the total. On the equity and liability side, we see the equity, we see retained earnings, we see the profit of the year, we see long-term debt, we see short-term debt, and we see total equity and liabilities. Now, what is the objective of a cash flow statement? In a cash flow statement, I want to see the change in cash. But the change in cash I can already see here, because I see the cash of last year and I see the cash of this year. Accordingly, I can see the change in cash here. I just have to subtract from this year's cash, last year's cash, and that's the change in cash. This is what we call the total cash flow. So, this video could end here if it was that easy. Of course, that number is not so interesting. What we are interested in is where the change of cash comes from. Does it come from operating activity? Does it come from investment activity? Or does it come from financing activity? If it comes from operating activity, everything is fine because the company is well off, they're generating enough cash. But if the cash comes from investing activity, it means that the company has disinvested to a large amount. So they have sold assets or sold whatsoever, and they generated the cash flow from their substance. And even worse, if the cash comes from financing, they just took new credit, and that's where the cash is coming from. That can be interesting if they have good investment alternatives, of course, but it can be very bad if the company just compensates operative negative cash from operating activities. So we have to look where the sources of the cash flow are. Are they from the cash flow from operating activity, from investment activity, or from financing activity? I just made one certain assumption here on the in the equity. Usually, the income statement is a sub-account of the equity. So this is what we all learn in very basic accounting classes. I made the assumption here that the profit is already appropriated. That means it is already spent or distributed as a dividend, or it is retained, so we would see it here in the retained earnings. It is not on the profit account anymore, so we see the profit with 0 here and with 0 here. Probably the retained earnings have gone up if the profit was retained. If the profit was not retained but spent as a dividend or distributed among shareholders, we don't see any movement in the retained earnings too. Of course, this can be adapted to other situations where we see profit on the profit account or whatsoever. So this is a simplifying assumption. I leave it to your own creativity to adopt this example to other real-world cases. The first step that we have to do for creating a cash flow statement is to create a movement balance sheet. And the movement balance sheet tells us about the change of all items. And if I speak of change, the change of a number is usually written with a Greek letter, that is delta. So here we see a delta, and delta always means change in. So here we see the change in non-current assets. Here we see the change in current assets. Here we see the change in cash. Here we see the change in total assets. Same on the equity and liability side. Here we see the change in equity, and so on and so forth. If we look here, the change in non-current assets is always given by the non-current assets of this year minus the non-current assets of the previous year. The same is true for cash. The change in cash, and again, this is the total cash flow, this is what we are looking for, is the cash balance of this year minus the cash balance of last year. And there's a second point I would like to show up. The change in retained earnings. Here we see a change in retained earnings are the retained earnings of this year minus the retained earnings of last year. But that, of course, must be the profit minus the dividend. Because the profit is the change in equity due to earnings, and the dividend is what we have already distributed among the shareholders. So what we see here is the appropriation, and that is reflected in retained earnings. So the change in retained earnings is profit minus dividend. The change in profit, or the profit account, the income statement, is again 0 because the appropriation is already done. The next step, the second step, is reordering. If we assume the whole balance sheet as an equation, we would have an equation sign in the middle. And of course, we can reorder equations by subtracting certain items on both sides. And this is what was done here with the delta of non-current assets and with the delta of the current assets. So they swapped the side from the asset side to the equity and liability side. Here we now have the delta of the non-current assets, the change of the non-current assets, and the change of the current assets. Of course, like in mathematics, we now, since we're deducting on both sides, they will now get a negative sign, a minus sign. Don't forget that. Everything that comes from the asset side and swaps the side has to get a negative sign in front. We only leave the cash and cash equivalents, or the change in cash and cash equivalents, on the asset side, because this is what we want to explain. And seemingly, this is what we use to explain the change in cash and cash equivalents. So, where does the change in cash and cash equivalents come from? It comes from the profit. Oh, where does the profit come from? Well, of course, I just go back one slide. The retained earnings. The retained earnings is profit minus dividend. So the change in retained earnings is profit minus dividend. And putting this into two lines is profit minus dividend. So this is the change in retained earnings. But of course, there are further items where the cash could be generated. It could be generated from the equity. This is a very unusual situation, but for example, like collecting more equity from the shareholders would give new cash and would give new equity. So the change in equity would have or would determine the change in cash. A change in long-term debt, getting in new credit, would increase the cash, of course, because if I take in a new loan, I would have an influx of cash. The same is true for short-term debt, of course. Now we see why we have a minus sign for the non-current assets. Because if we invest into non-current assets, or if we invest into current assets, money is leaving the company. Accordingly, we have a negative cash flow if non-current assets or current assets go up, and then cash would go down. If we now order all those items that explain the cash flow and we draw some subtotals, we get this. Now the subtotals, of course, are the cash flow from operations, the cash flow from investments, and the cash flow from financing. What comes into the cash flow from operations? Of course, the profit of the year. Let's go into the depreciation line here later on, and the change of current assets, and the change of short-term debt, or current liabilities, let's put it like that. So what we see in these two lines here is the working capital. And of course, the working capital is very, very much operative. So profit and change in operative assets and operative liabilities. What is the cash flow from investments made of? Mainly what we can invest in. So the non-current assets like machinery, real estate, stuff like that. So the change in non-current assets makes up the cash flow from investments. Again, depreciation we talk about in a few seconds. And the cash flow from financing, of course, is composed of the financing, which is made of the equity and the long-term debt. So the change in equity and the change in long-term debt and the dividend, again, the dividend and the profit is the retained earnings, right? But the dividend has to be deducted here since it is part of the financing. That's the cash flow from financing. If we now add all three subtotals, the cash flow from operations, the cash flow from investments, and the cash flow from financing, we receive this little calculation down here. This is cash flow from operations plus cash flow from investments plus cash flow from financing, and that gives again the total cash flow, which is the delta of cash that we just saw here. Now let's talk about the line depreciation that we see twice here. We have to make some adjustments or corrections for items that affect the income, the profit, but not the cash, because this line is kind of diluted. The profit is not fully cash equivalent or cash effective. Especially the depreciation does not affect cash, because there's no cash going out of the company, nor is there any cash coming into the company. So we have to correct the profit for the depreciation. Thus, we have to add the depreciation again to the profit, because it was formerly deducted, now it has to be added again. But stop! If we now add something to the profit, the whole cash flow statement wouldn't reconcile anymore, because these subtotals add up to total cash flow. This equivalent sign still has to hold, and if I add something, it doesn't hold anymore. Accordingly, I have to make this correction twice. I have to make this correction again in the investment section, because the non-current assets are those assets that have been depreciated. So I have to deduct the depreciation here again. So once with a plus and once with a minus. So keep in mind, those corrections that correct the profit have always to be done twice, once with a plus and once with a minus. Another example would be the creation of provisions, but many provisions are short-termed, and if you correct the profit in the operations section, you would have to make the second correction also in the operations section, so you can simply leave it out. Only those provisions that are part of the financing have to be corrected here and here again. But the depreciation is the usual example that has to be kept in mind here. Let's go into some real case. This is the balance sheet that you already know from other videos. Of course, this balance sheet is lacking of the previous year, so let's shorten it a little and simplify it, and let's put the previous year in. What other changes have I made? Of course, I had to exclude the cash and cash equivalents. So let's have a look. Here the current assets are around 20,000 and cash is still included. Here the current assets are around 12,000 and cash is excluded, because I need cash to be an individual item for my calculation. And of course, here in total equity, I just added all items but the reinvested earnings. So all other items are simply totaled. So here we have reinvested earnings, and here we have all other equity items, but they still sum up to the same total equity here. Now we have everything on one screen, and I just take a pencil so that we can check what I have done. Let's go through. Here we see the profit of the financial year, 1,703. Let's check mark that, because it equals the consolidated net income. The depreciation is not given in the usual income statement. So you have to look it up in the notes of the financial report. Delta current assets comes from here, so 2,310, but mind the sign, so we have to deduct 2,310. Plus the change of short-term debt. Short-term debt is here, current liabilities. We have minus 28. We add minus 28. And given those items, we have now received the cash flow from operations. And that is again given here. Let's go into the investments part of the cash flow calculation. We have minus the change of non-current assets. Here we have the non-current assets. The change is negative, so we have minus the negative change, which is plus. And the depreciation again, it's given here, and it's given here again. So adding both will give a negative cash flow from investments. By the way, this is very typical. I just put it there. It is very typical that the cash flow from investments is negative because usually companies invest some money into their assets, but they have to depreciate them later on, which does not lead to cash inflow or outflow. So we will always have a negative, or nearly always have a negative investment. Only if we sell assets, then it could turn positive. So here it reflects again. We have the change in equity, that doesn't change. We have the change in long-term debt coming from here. It has a negative sign, so we add a negative change in long-term debt. And we have the dividend payment. Where does that one come from? Here we have the reinvested earnings and the consolidated net income coming from here. 1,703 minus the reinvested earnings, 1,300. That's the dividend that has been distributed, and that's 403. And that, since it must be deducted, we deduct 403 here. Subtotaling all those items will give minus 3,793, mainly driven by the payback of some loans. So here the money is gone. So what do we see? We see generating profit or generation of cash. And we see a payback of credit. And that's mainly it for this company. So our total cash flow is minus 275, and we see that again here. So seemingly our cash flow calculation reconciles because these numbers are still fitting. So I hope this video helped you. Thank you for listening and see you in the next video.